Welcome to the Opening Bell Report.
68%. I just want you to sit with that number for a second. 68%. If that happened to your home value, you'd be in a full-blown panic. If it happened to the temperature outside, well, we'd be in an ice age. But we're not talking about real estate or weather. We are talking about a single-day drop in a stock price.
It's the kind of number that makes you tap your screen. You assume the pixels are broken. It's just, it's violent. It is the financial equivalent of a car just driving straight off a cliff.
Exactly. We're looking at Fractal Health, ticker symbol GUTS, and I have to say that ticker feels incredibly appropriate right now because you need a stomach of steel to even look at this chart.
No kidding.
As we speak, the stock is hovering around, what, 58 cents?
Yeah.
To the average person, this just looks like a crime scene. It looks like a company that is dead on arrival.
On the surface, absolutely. A total disaster. A liquidation event in the making. But, and this is a very big but, that's exactly why we're digging into it today.
Yeah.
We have an analysis report in front of us that looks at this exact same wreckage, sees the same red lines, and doesn't see a funeral. It sees a Black Friday clearance sale.
And that is the mission for this deep dive. We aren't just, rubbernecking at a crash site here. We're going to unpack this report that argues the market has completely lost its mind on this one. We're going to look at why a stock drops 70% overnight, dig into the nuance of the medical data that triggered all this panic, and then explore the argument that we might be staring at a massive rebound opportunity.
It is the classic contrarian setup. The blood is in the streets, as they say. But before we get ahead of ourselves, we need to be crystal clear with you listening. This is high-risk territory. We're talking about catching a falling knife. But the report argues that the floor, the concrete slab where that knife stops, might be a lot closer than people realize.
Right. So this is for the dip buyers, the contrarians, the people who see a burning building and wonder if the land value is still good. Let's start with the catalyst. I mean, a stock doesn't lose nearly 3/4 of its value just because it's a Tuesday. What actually happened to Fractal Health?
It all comes down to a clinical study called Remain-1. And to understand why this study mattered so much, we have to zoom out to the current obsession in the biotech world, GLP-1s.
Oh, yeah. Ozempic, Wegovy, Mounjaro. You can't avoid them.
You know them. You see the commercials. They're everywhere.
The weight loss miracle drugs. But the narrative on these is shifting a little bit, isn't it? It's not just, do they work anymore?
Precisely. We know they work.
Yeah.
I mean, that's settled science. The problem and the massive opportunity is in the forever problem. These drugs are incredible while you take them. But the dirty secret, which isn't really a secret anymore, is what happens when you stop.
The weight comes roaring back.
Almost immediately. It's a powerful physiological rebound.
Which makes sense, right? You stop the chemical intervention, the body fights to get back to its old baseline, so this is where Fractal Health comes in. Their pitch wasn't another injection, it was a procedure.
Correct. They have a proprietary procedure called Revita. It's endoscopic, so no scalpels, no stitches. They go down the throat and resurface the lining of the duodenum. The theory is that by changing the lining of the intestine, you can alter the metabolic signals that are sent to the brain.
Okay, so they're physically altering the gut to change how the body processes sugar and fat. And the goal of this Remain-1 study was to see if Revita could act as an off-ramp for the drugs.
Exactly that. Can we perform this procedure on a patient, take them off their Ozempic, and actually keep the weight off?
That sounds like the holy grail. I mean, if you can get patients off weekly injections, which are expensive, have side effects, and are a hassle and keep the weight off, that is a multi-billion-dollar idea. Easy.
It is.
So judging by the stock price sitting at 50 cents, I'm going to assume the answer was a resounding no.
Well, see, this is where we have to peel back the layers. This is where scientific reality just clashes with market psychology. The investors, fueled by all the hype around weight loss, they were pricing this stock for perfection. They wanted a miracle cure.
0% weight regain.
Zero. They wanted it to look exactly as if the patient was still taking the drug.
That seems like an incredibly high bar for any medical intervention. Biology is messy. It rarely deals in absolute zeros. So what did the data actually say?
The patients who got the Revita procedure regained 4.5% of their weight after coming off the drug.
Okay, 4.5%. That is not zero. But is it a disaster?
To the algorithms, yes. To the panic sellers, absolutely.
Yeah.
They saw weight regain, they saw a positive number, and they just screamed failure. They hit the eject button because the narrative of cure was broken.
But hold on, context is everything in science. If I stop taking Ozempic and I don't get this procedure, if I just go cold turkey, what happens?
That is the critical piece of context the analysis report highlights, which got completely buried in the avalanche of selling. The study included a control group of people who stopped the drugs and just had a sham procedure done. That group regained 7.5% of their weight.
Let's just pause and do the math there. The control group gained back 7.5%. The treated group gained back 4.5%. That's a difference of 3%. So the procedure did work. It physically reduced the weight regain.
Precisely. It offered a statistically significant benefit. It slowed the regain. It wasn't the magic bullet that freezes your weight in time forever, but it had a measurable positive effect compared to doing nothing. It proved the mechanism works.
So the analysis here is that the market punished an imperfect result as if it were a total failure.
That's the core of the argument. The report suggests the market priced okay data as if it were death data. A 70% haircut implies the technology is useless, that the company should just pack it all up and go home. But the data shows the technology works. It just didn't meet some impossibly high bar set by Wall Street.
It's interesting because statistically significant is usually the golden phrase in biotech. Usually you hit significance, the stock pops. But here, the magnitude of the benefit just wasn't enough to satisfy the hype machine.
Exactly. And to play devil's advocate for a second, the market is asking a commercial question. Is a 3% difference enough to convince an insurance company to pay for an endoscopic procedure?
That's a fair pushback. Is it enough to convince a patient to do it?
Right. It's not just about did it work, it's about is it marketable? If the benefit is marginal, maybe the market just isn't there. But, and here's the pivot, does hard to market equal company is worth nothing? That's the disconnect. It's like getting a B- on a test and your parents deciding to sell the house and live in a tent. The reaction seems wildly disproportionate.
That is a very apt, if depressing, analogy. And that disconnect is what sets up the financial opportunity, according to the bull case in this report. Because at the end of the day, a stock price isn't just a mood ring, or it shouldn't be. It's supposed to reflect tangible value.
Which brings us to bull case number 1, the financial floor. When a stock drops this fast, valuation metrics get completely distorted. We need to look at the market cap versus the cash on hand. This is where the numbers get really wild, almost hard to believe.
Okay, let's break that down. Where does Fractal Health stand right now in terms of just raw dollars?
After the crash, the market cap, the total value of all the shares, fell to around $90 million.
$90 million. For a publicly traded biotech with late-stage data, that is tiny. That's micro-cap territory.
It is. But here's the kicker. Based on recent estimates, they have roughly $65 to $70 million in cash sitting in the bank.
Whoa, wait a minute. Run that back. The whole company is valued at $90 million, and $70 million of that is just cash, like US dollars in a checking account.
Exactly. This is what we call trading near cash value, and they have a runway. They can keep the lights on into 2026. They are not going bankrupt tomorrow.
So if you do the math, 90 million market cap minus 70 million cash, the market is valuing the actual business, the patents, the tech, the scientists, everything else, at $20 million.
It's the zero value logic. When a biotech stock trades this close to its cash value, the market is effectively saying, we think your business is worthless. In fact, we think you're going to burn this cash so inefficiently that we won't even give you credit for holding it.
That seems absurd. We just established the procedure did have a statistically significant benefit. Even if it's a niche product, surely the intellectual property alone is worth more than $20 million.
That is the inefficiency the report is pointing at. Even if you think the Revita procedure is niche, is it worth zero? The report argues this creates a very hard floor for the stock price. It's effectively trading at liquidation value.
It's like buying a wallet for $90 that has $70 inside it. You're really only paying $20 for the actual leather wallet.
In this case, the wallet isn't empty leather. It has a massive IP portfolio. Which actually leads us to the second pillar of the bull case. Because we've been talking about Revita, but investors seem to have developed tunnel vision.
Right, the forgotten asset. I love this part of the report. It feels like finding a hidden feature in a video game that everyone just missed. Everyone is so focused on the weight loss study, they forgot the company does something else.
They did. The panic selling was all about Remain One. But Fractal has a whole other arm of the company called Rejuva.
Rejuva. Sounds a bit like a high-end spa treatment.
Significantly more high-tech than that. It is a gene therapy platform designed to target the pancreas directly.
Gene therapy. Okay, let's unpack that. Because usually when you throw the words gene therapy into a biotech investor deck, you're talking about a multi-billion-dollar valuation just on the promise alone.
Usually, yes. The idea is to treat type 2 diabetes at the genetic level within the pancreas, to fundamentally change how the pancreas produces insulin. Now, to be clear, this is earlier stage. The report calls it a moonshot. High risk, massive potential upside.
But here's the crazy part. Because the stock is trading at roughly 50 cents, basically at cash value, what is the market paying for Rejuva right now?
Nothing. Literally zero. It is not factored into the price at all.
A free gene therapy pipeline.
That's the argument. If you buy the stock at these levels, you're paying for the cash on the books. Maybe a tiny premium for the Revita tech, the Rejuva platform. That's just thrown in as a free gift with purchase.
It's an asymmetric bet. We hear that term a lot. Can you break that down for us in this context?
Sure. An asymmetric bet is when the potential upside vastly outweighs the potential downside. If you buy GUTS at 50 cents, your downside is 50 cents. You lose what you put in. But if Rejuva shows even a glimmer of promise, or if Revita finds a niche market, the stock could go to $2, $3, $4.
So the downside is capped, but the upside is technically uncapped.
Correct. And right now, the upside isn't priced in. Not even a little. The market is so panicked about the 4.5% weight regain data that they've completely ignored the rest of the company. It's like they burned the whole house down because they didn't like the drapes in the living room, forgetting there's a safe full of gold in the basement.
It really highlights how emotional the market can be. We think of it as this rational, calculating machine, but it's not. It's a mood ring. And right now, the mood is panic.
The panic creates opportunity, but it also creates volatility. And that brings us to the technical setup, because even if you don't care about gene therapy or weight loss data, even if you're just a trader looking at lines on a chart, there's a strategy here.
The gap fill. I see this in the report. This isn't about fundamentals. This is about market physics.
Exactly. The report brings up the idea that stocks rarely go down in a straight line forever. Even terrible companies have bounce backs. Fractal is sitting at extreme oversold levels on the RSI.
That basically measures how stretched the rubber band is to the downside.
Correct. And when that rubber band gets stretched this far, it usually snaps back. Not because the fundamental news changed, but because the sellers are just exhausted. Everyone who wanted to sell has sold.
And that's when the shorts start covering.
Exactly. Short sellers have to buy the stock back to lock in their profits. When they start buying and the bargain hunters step in, you get a volatility snapback or a dead cat bounce.
Gross image, but effective. So what's the target here? We're at 58 cents.
The report suggests a technical move back to 80 cents or even $1 is very plausible, just as a stabilization move.
$1 doesn't sound like much when the stock used to be way higher, but...
You have to look at the percentage. If you buy at 58 cents and it goes to $1, that's a 70% gain.
That's massive. That meets the S&P 500 for 5 years combined.
That's the power of low-priced stocks. You just need it to stop bleeding and stabilize. The report argues that a simple gap fill could generate 40 to 70% returns very quickly.
So we have the fundamental floor of cash value, we have the free option of the gene therapy pipeline, and we have the technical setup of a massive oversold bounce. It sounds almost too good to be true.
And that is why we need to pump the brakes. We have to be objective here. This is not a savings account. This is a biotech stock that just face planted.
Yeah, let's talk about the risks, because the expert who wrote this report isn't saying sell your house and buy GOTS.
Definitely not. They explicitly call it a falling knife. Trying to catch a stock while it's crashing is dangerous. You can get cut.
What's the worst case scenario here, besides the stock going to zero?
Well, cash burn is a big one. We talked about that $70 million. In biotech, money evaporates. You have to pay scientists, run trials. If they burn through that $70 million faster than expected, that floor we talked about lowers every single day.
And if they run out of money?
They have to raise more. And when a company with a 50-cent stock price raises money, it usually means dilution. They sell millions of new shares, which dilutes the value of your shares. It's like slicing the pizza into smaller and smaller pieces.
Dilution is the enemy of the shareholder, the silent killer.
It is. And there's always the risk that sentiment just doesn't shift. Sometimes the market decides a company is dead, and it stays dead. It can trade sideways at 50 cents for 2 years, and that's just dead money.
So if you're looking at this, you have to be comfortable with volatility. This is not for the faint of heart.
No. The report makes it clear. Do not bet the farm. This is a speculative play. But the risk-reward ratio is skewed in your favor if, and it is a big if, you believe the market overreacted.
It really comes down to that central thesis. Was the Remain-1 data a disaster, or was it just okay?
That is the million-dollar question. If you think 4.5% weight regain is a total failure, the stock is priced correctly. If you think it's a useful, statistically significant result that got punished too hard, then 50 cents is a steal.
It's amazing how much of investing isn't about the numbers themselves, but about the interpretation of the numbers.
That's what makes a market. For every person panicking and selling at 58 cents because they see a failure, there's someone on the other side saying, "Thank you very much, I'll take that."
It's a battle of narratives, the failure narrative versus the overreaction narrative.
And the winner of that battle determines the price.
So let's just wrap this up. We've got a company, Fractal Health, battered and bruised, down nearly 70% in a day. The market hates the weight regain data.
But the nuance, which the algorithm missed, is that the data was better than doing nothing. It was clinically effective, just not perfect.
Right. And because of that imperfection, the stock is now trading at roughly the value of its bank account.
Which implies the business itself, the patents, the labs, is free. And on top of that, you have a gene therapy pipeline, Rejuva, also thrown in for free.
And a chart that is so oversold, the technical indicators are screaming for a rebound.
It is a fascinating setup. It really forces you to ask yourself,
Yeah.
How efficient is the market, really?
That's the big question. We are taught that the market is efficient, that price reflects all available information.
But if that were true, would a company with 70 million in cash and a working product trade at 90 million?
Probably not. It implies that fear is driving the bus, not math.
And if we connect this to the bigger picture, we live in an era of algorithmic trading. Headlines hit, computers read keywords like regain or miss, and they sell instantly. They don't stop to read the nuances about control groups or cash runways.
They shoot first and ask questions later. Or rather, they shoot first and let the humans ask questions later.
Exactly. And that raises an important question for you to think about. In this high-speed environment, how often does the market confuse imperfection with failure? And is that confusion actually the wildest opportunity left for a human investor who's willing to actually sit down and read the full report?
That is something to chew on. Is GUTS dead, or is this the buy of the year?
We'd love to hear what you think. Check out the charts, do your own research, and decide if you have the guts for it.
Had to get one more pun in there.
You know, I couldn't resist. Thanks for listening to this deep dive into the madness of market reactions. We'll catch you on the next one.
Stay curious.
Don't forget to like, share, and subscribe for more.